I have heard so many times that we have reached the low in interest rates ever since the 1980s. That every down cycle is the end of the bull market. But the work that we've done that is based on the work of Eugene Fama for his work in securities prices and the follow a random walk, which is the drunk in the snow, is that we have yet to see a reversal in the trend that has been in place since the early 1980s. And so it has been a fool's game so far to every time we make a new low in rates to predict the end of the bull market. And until the market tells me something different, I'm not really in a hurry to join the crowd. And Brian, there's a lot of good reasons to believe that we haven't reached the end. One is the prospects that as the U.S. Treasury keeps spending all of its cash, it's driving interest rates lower, even though it's stimulating the economy, because as the cash gets into the economy, people are investing it in bonds and stocks. The other thing is, and I thought CNBC did an excellent story yesterday on this, is that there's now discussion about the idea of another Operation Twist, where the Federal Reserve, because interest rates are getting so low in the front end of the curve and could go negative, that they'll sell their short duration assets like Treasury bills and start buying longer maturity assets that would drive rates down.
And that's the part of the story I think that our audience may not get, because they think, oh, you're talking about getting a stimulus check and buying GameStop. That's not what you're saying. What you're saying is that surveys show a huge percentage of the stimulus is going to be saved or paid off debt. Even putting something into your checking or savings account is a government transaction in a sense, right? Very short-term T-bills. There is a financial knock-on effect even from doing something as benign as that with the stimulus checks.
Well, that's right, and that's kind of what I get into in the paper is you've got to get into this arcane world of monetary policy and how it all works at the Federal Reserve. But the U.S. Treasury keeps its checking account, if you will, with the Federal Reserve. When they spend money out of that account, it goes into the economy. And in this case, it's going out in the form of largely in the form of checks to individuals. Well, our experience is showing us that a lot of these checks are going to people that really don't need the money, and they're saving it. And so that money either gets deposited in the bank, which means the bank has to go buy some sort of short maturity or a low risk security like Treasury bills or Treasury notes or asset-backed securities or CLOs or whatever, or the market or the person invest the money directly into the market. And that's what we're starting to see with asset valuations is as the government keeps putting this money into the economy, it's unlike what we went through in the prior QE experience. We're actually increasing the amount of dollars in people's bank accounts, and that's not what we did back in 2009 and 2010.
Shepard Smith here. Thanks for watching CNBC on YouTube.